Good morning, everyone. This is Beth Rickliffs with IMES Insurance Agency Marketing Services. I'm a life insurance sales director here. Thank you for joining us today. I feel like we have a very wonderful presentation ready for you today with F&G. Miles from F&G is going to be talking about the benefits of fixed index universal life and the gifts going forward that you can set up for juveniles. So it's a good topic around this time of year for certain. I'll do what we always do with our webinars is I know we're starting a little bit late. I will go quickly through an introduction with IMES, and then we will get to the meat and potatoes after that. So some of you on the call I recognize and have done business with us for many years, and there's also some new people on there, so it's always a good refresher. But if you're new to IMES, we do have a new producer builder program that is designed to get you in motion with IMES as soon as possible. So if you are doing certain levels of production in the first 6 months, you are going to be rewarded with different benefits. So, for example, $100,000 of fixed index annuity business would qualify you for $750 of cash or an iPad. If we move it up to $750,000, then that's digital leads, video, social media campaigns. You can cash out at any time in that 6 months once you hit the production level that you want and the prize that you want. Life insurance business does count as well, and how that works is it's usually 10% of the amount of the annuity. So $10,000 of target, for example, would be the first level on life insurance, and it can be a combination of life and annuities too to get you to those production levels. It is always nice to have brand new agents, but we want to maintain your business and have incentives going forward. Our business is a lot like yours in that some of our very best agents that we work with come from word of mouth from our other producing agents. So we do offer a referral bonus of $50 of a one-time bonus when the agent that you refer to us is contracted. And then we also offer commission on top of that for their target life, index annuity, premium, single premium life, and MIGA. That's not a haircut off of their street level top commissions or yours. It's out of the pocket of IMES. We offer marketing reimbursement because we know how important it is to reinvest into your business to have more sales. So for every $100,000 of index annuity premium, you're going to earn $100 in marketing reimbursement. That equates to $200 per $100,000 of SBL and $200 for every $10,000 of life. And that can be used with any of our creative marketing services that we offer. It could be things outside of IMES that you're already utilizing, or maybe there's some network marketing groups that you may belong to, such as BNI, that you could get marketing reimbursement on that. We have a tremendous back office support, whether it comes to case management, our marketing directors with case design. Our website is a big key feature in the back office support that we offer when it comes to quote engines, resource libraries, etc., finding forms online, submitting business electronically. We do paperless contracting through a system called Surance Bay, which I'm sure most of you are familiar with. And I did mention a little bit about our website, but it's a great resource. It has, on the life insurance side, we've got the life quote tool system for term and GWell. We also have a final expense calculator. You can find forms, brochures, upload applications. One of the greatest tools on here is, if you go to support, is our sales resource library that is in there, which has any kind of topic you can think about, buy-sell agreements, key man insurance, 162 bonus plans, etc. That's really easy to get registered for. So if you haven't done that yet, go to www.imsinc.com, and then over up here, you'll see that log out or log in. That's where you'll register to be able to use our website. The way of the world has switched significantly since COVID, I would say, and that e-applications have really taken off. And that has been, I think, a very positive thing for the industry, because applications can get submitted quicker, less mistakes if we do it electronically. Also, with the way of the world with Zoom meetings, webinars, and things like that, you're able to do a lot of appointments virtually, which is a key part with the e-applications. We have a couple of different platforms. Firelight is going to be more towards the annuity side. iPipeline is going to be more life insurance related, although there's Allianz, F&G, and National Western Life that I believe are on Firelight. iPipeline is going to pick up most of everything else. Sunfire is related to Medicare. And then Anaco has their own portal on our website for us to do applications electronically. And those are all on IMS Inc. As well. Here's kind of the rundown of all the different annuity products that are on there, and then you can see there's a handful there on Firelight. If you don't see it here on Firelight, then chances are we're going to be able to find it on iGo eApp. We have a wonderful creative marketing team, lots of different types of talent on that team. The benefit with us of using our marketing team to plan your marketing for the year is that you're not having to recreate the wheel. Chances are, if there's something that you're asking for, it's something that we've already created and we can tailor make it towards you. You're also dealing with a group of people that are very much educated on the insurance world. So if you were to outsource to another marketing organization, you're having to explain regulation and how things work. Our creative marketing team already knows all of that. Of course, you can use your marketing dollars for anything that we have with the creative marketing solutions team. If you are working with a sales director such as myself or an annuity sales director, and you have not done a marketing analysis, I would highly encourage you to reach out to a marketing director and do that. That will be a short form that essentially takes a picture of what are your marketing efforts right now and where do you want to be in the business down the road. And then we send that over to creative marketing, and they put together basically a free business plan of marketing strategies that you can utilize throughout the next year. We have IMS Wealth Management, so we have a little bit of everything here at IMS. Of course, we're very strong on the annuity and life insurance side. For life, I also handle long-term care and disability. We've got Medicare, and then if we're wanting to get all the pieces of the puzzle, we have IMS Wealth Management for assets under management. And IMS Wealth Management, our group of people that we have very experienced advisors in that area. We also have people that are wanting to move into that space and get the rest of the pie by adding assets under management. So if you haven't taken your 65 and you're wanting to know how do you get into that space, IMS Wealth Management for sure can help you bridge that gap. Or if you're wanting to investigate different solutions and you're already doing assets under management, I would definitely have a conversation with IMS Wealth Management. You'll want to talk with Duncan. We do a trip every year. We're working on the Seaside Sanctuary right now. Our qualification period is for 18 months instead of just 12 months. So hopefully you can join us on that trip. Please follow us on Facebook and LinkedIn. And with that, I'm going to pull up our technical difficulty this morning was that we couldn't get Miles in on the webinar. So, yeah, he's still not able to do it. But you're there, Miles, right?
I'm here. Can you hear me?
All right. Yep, I'm going to bring over your slides here.
Yep, absolutely. That's it. I appreciate it, Beth. I know you and the IMES team, right? We did have a little bit of technical difficulties, but we'll be able to get through this easily. And I promise it'll be easy on you, Beth. And I appreciate you being the one that advances the slides. But talking about college planning, right? I think the title of the webinar invite is very timely, as Beth mentioned, helping clients give a gift that lasts a lifetime, right? And we're really, why is that timely? Of course, it's the holiday season. We've seen a lot over the past year to 18 months talking about inflation. I don't know about any of you on the line, but I do watch quite a bit of news. Maybe I shouldn't for my mental health, but I do see a lot talked about the cost of inflation and how it compares to other sectors. And, college tuition in general has skyrocketed over the years. We'll go through this slide deck and talk about some of the most recent statistics, but I graduated college about 10 years ago, and I could not believe how much the cost of tuition has gone up since that 10-year period. So we'll go ahead and advance the next slide in talking about the agenda, right? So why college planning? And some of this information may not be new news to any of you, but again, we're going to have some really great data in here that you can share with your clients or maybe pull out of this presentation. The importance of planning, different types of college funding vehicles, the pros and the cons. And then if we're looking at using life insurance or an IUL on a child or juvenile to fund for college, which is something that we absolutely support here at F&G, and it's a great tool for parents or grandparents to gift to their children or grandchildren. What are a few concepts, and one of them that we generally talk about or hear a lot about in the industry is a $1 million baby concept. So how can a parent or grandparent fund an IUL for their child or grandchild to help them save for college funding, retirement, or some other need down the road, right? How to get them set up for success early on in their childhood. And an IUL is a great tool or resource to use for a multitude of reasons, and we'll get into those throughout the presentation. And then at the end, we'll just spend a few moments covering our flagship Pathsetter product. It's going to be the #1 product for most quartiles, not only juveniles, but other ages as well. And then our underwriting program that makes it really quick, easy, and hassle-free for applicants to apply. And then we've also built out a new e-app platform, which is through Firelight. And we've built in an Insta approval program, and we'll talk about how that relates to juveniles and how that conversation can help with college planning. So going over to the next slide, right, why college planning? So we'll just spend the next few moments going on to the next slide now, talking about, why college planning, right? So, right, if we're taking a look at education and the average earning, a child or an individual that receives a bachelor's degree on average earns 88% more than someone who graduates with just a college degree. And then if someone goes on past their bachelor's degree, they're expected to earn 265% higher pay on an annual basis than someone who graduates with a high school diploma only, right? And we all know, right, that generally those who are going to college are going to earn more than someone who doesn't go to college. And as we're going throughout this presentation, keep in mind some of the plans that we talk about aren't necessarily applicable to maybe a student who graduated high school, takes a few years off. Maybe they decide not to go to college and they want to start their own business, or they go directly into a profession. And bring it all back, and I'll do this at the end, but think about how this IUL will allow for more flexibility than other plans that are out there designed specifically for college education expenses. Now, Beth, going on to the next slide here, education and job security. As Beth mentioned, the industry has certainly changed, our industry, the insurance industry, since COVID. But this shows you here on the screen data from December of 2022 going all the way back until 2000, the unemployment rate and how it relates to education levels. So if we take a look at the purple line, or the purple benchmark there, that is going to be for individuals that have a college degree or greater, some college, high school diploma, and then no high school diploma. And as you can see, throughout the years, over the past 22 years, individuals who have a college degree have a significantly lower unemployment rate or chances of becoming unemployed. So again, a lot of this data is already going to be known to you and your clients, but I think this really highlights and puts it into great perspective, the importance of continuing education after high school. So talking about the importance of college and individuals going on past high school, Beth, now we're on the importance of planning, and I'm going to tab to the next slide here, going to the rising cost of tuition. Now, these next few slides are the ones that really surprised me when I received this slide deck from our marketing team. But as we can see, it gives you, based upon the rising cost inflation, apparel's up 30%, cars, coffee, sweets, gas, housing, and then medical care. But as you can see, that the average annual increase for college tuition is significantly higher than all of those other expenses that we're typically benchmarking for tuition. And if we're taking a look at the future, right, I don't mean to get political here, but there hasn't been much done in the way of politics to slow down that rising or rapid inflation when it comes to tuition. So we would expect, as smart individuals in the financial services industry, that the cost of college is not going to drastically slow down or be cut in the near future. Now, taking a look at the next slide here, right, this shows us a projection of the cost of a child attending college, receiving a 4-year degree, either in a public or private school. And if we're looking at today's numbers, you're going to see those down at the bottom of the screen. So 2022 to 2023, the per year cost on average for a public school is just north of $23,000. And for a private school, that's $53,000. And if we're taking a look out, right, for a newborn born in either 2022 or 2023, we could expect them, based upon historical data, for a public school to pay in a grand total for a 4-year college degree, $250,000, or for a private school, it could be just north of $500,000. So as you can see, right, college tuition is not slowing down. And as we're talking about, savings with our clients, whether that's in the form of investments, annuities, life insurance, they really need to be putting at the forefront how they're going to help pay for college or help their children pay for college in the future. Going on to the next screen here, planning for more than just 4 years, right? I did not graduate college in 4 years. It took me 5 years. I was the final few years, I decided to go into the workforce full time and also take classes full time as well. That was probably the most hectic time of my life, but because I couldn't take a, technically full caseload like some of my other peers that were going to school full time and maybe working part time, it did take me an extra year to graduate. That wasn't an issue for me. I enjoyed working in the workforce, but it does generally take longer than just 4 years for an individual to graduate with a bachelor's degree. And then thinking of those more those degrees or industries, for example, healthcare, lawyer. There are a multitude of others. Generally, that's going to be more than just 4 to 5 years for those individuals to graduate. And parents and children need to plan for paying, significantly more over a 6+ year period. Now, going on to the next slide here, Beth, if we're taking a look at the college cost, it is increased 23% since 2013, with 2021 to 2022 being at $22,000 a year. But if we compare that to the total financial aid that has been paid out, that is decreased by 6% over the same period of time. And that leads me to my next slide here that talks about how families cover college expenses versus their reality and expectations. So the chart on the left shows that 37%, or based upon families that took this survey, 37% expected to pay for their children's college via investments or income. So out-of-pocket expenses, 22% of the college tuition would be paid for by the students or parents taking out a loan. And then they expected about 41% of tuition to be covered by grants, scholarships, or family gifts. Now, looking at the right side, what is reality? 54% is paid for of the college tuition is paid for by the family via their income or investments. That's a 13% increase than what they expected. And then 17% higher, 17%, or excuse me, that's 17% more than expected out-of-pocket cost. 18% is actually paid for by the students or parents taking out loans. So that's a slight decrease than what they expected. And then there is a 28% is covered by grants, scholarships, or family gifts, and that's 13% less than what they expected. So as you can see, what clients expect and what they talk about or think is their expectation as of today is likely not the reality or the outcome that they'll see. So having additional investments or some type of way for the family to pay for college expenses is going to be instrumental in why this conversation is so important, especially when looking at the rising cost of tuition and how that's going to increase over the years. Moving on to the next slide here, financial aid, right? There's about 55% of families receiving grants or financial aid, and 60% of families receiving scholarships or some type of grants. This just shows you, right, who's actually receiving. And as we all know, that a lot of these scholarships, grants, or assistance provided by the government is typically looked at or tapped when it comes to a family's combined income. So although we do have a significant amount of individuals receiving grants and scholarships, it's probably, as we saw on the last screen, going to be a little bit lower than what they expected. And there are going to be some individuals, likely the individuals you're working with on a daily basis, who are high income earners that would possibly not even qualify for scholarships and grants. Now, Beth, I'm going to go ahead and skip over the next slide, but going on to the slide after that, how families cover college expenses versus reality, right? This is a good comparison, what a family could expect to receive from FAFSA, or the federal financial aid eligibility, based upon the the family's combined income. So assuming, right, that there's a two-parent household or a single-parent household, and then the assets that they have. I guess this is going to show you what the clients could expect to pay out of pocket. So highlights here on the screen, for example, if an individual or a family has a combined income of $150,000 a year and $200,000 in assets, the assets do not include their primary residence or retirement accounts, so keep that in mind. They would expect to pay $43,000 out of pocket to help put their children through college. So again, a lot of this data is right on your right at your fingertips. It's somewhat known, but it's not talked about a lot. And usually it's a sticker shock for families that are starting to put children through college. And it's great to have those conversations with your clients early on. How are you saving for your children's college tuition? So now moving on here to college funding vehicles, right? I don't think it's fair for us to only talk about life insurance or an indexed universal life product when talking about the ways that clients can fund college savings plans. So we're also going to talk about the pros and the different types of college savings plans, and then the pros and the cons. And then of course we'll wrap up and talk about how to position an IUL versus those other types of plans. So what are the college planning vehicles? I'm on the next slide now, Beth. Right, there are generally going to be three that are most commonly known. And I would say if an individual was to Google, how do I, help save for my children's, college expenses, the top three here on the screen are more than likely going to be the ones that show up. But I think it's our job as financial professionals to not only know information and be able to talk about the pros and cons with our clients, but also position a product that we know very well, and that's cash value life insurance. So of course, there's a 529 college savings plan. There are custodial accounts, and then there's a Coverdell education savings account. And of course, the fourth, which I hope all of you are incorporating in your conversations with your clients, is cash value life insurance. So starting out on the next slide, we'll talk about the 529 college savings plans, right? These are going to be ways for individuals to save their after-tax dollars in a tax-advantaged ways, or families to meet the rising cost of education. They do have to set up a 529 plan. It's going to be tax-deferred compounding interest that is eligible or that they're eligible for. And then if the beneficiary, generally meaning the child, is paying for qualified educational expenses, those are tax-free withdrawals from the plan. Now, the account owner retains full control over the asset. Maybe their eldest child doesn't go to college. They're able to transfer the plan or beneficiary over to another child, which allows for some flexibility there. Or let's say, for example, maybe parents only have one child. That child, for some reason or another, doesn't go to college. Then there would be a tax consequence for those parents to withdraw those funds if they're not used for qualified educational expenses. So there's quite a bit of restrictions when it comes to a 529 college savings plan. And then there's also some restrictions in regards to the, for a lack of better terms, investment options for a 529 college savings plan. So taking a look at the next slide, the pros and cons, right? So it is tax advantage when looking at the pros. Tax-free withdrawals, assuming qualified expenses are covered. Flexibility in the ownership. And then, of course, the owner controls the account, meaning more than likely the parents. Cons, right? The funds must be used for educational expenses. So maybe they've saved too much inside this plan, and they've exhausted all of their qualified educational expenses, and they have money left over. Well, they would be penalized. The owner would be penalized for taking the funds back out. And then it could or will count against the family's financial aid, right? This is going to be considered an asset. So this could disqualify them or limit the amount of financial aid that the student would be eligible for. And then there are some transfer restrictions in regards to the beneficiary or who's eligible to receive those funds. Now, when looking at, on the next slide here, custodial accounts, a UGMA or UTMA, some of you say UTMA, I like to call it a UTMA, but they fall under the Uniform Gift to Minors Act or the Uniform Transfers to Minors Act. Generally, the difference is going to be what assets can be transferred under each plan. It does allow the transfer of financial assets to minors without establishing a trust. So thinking of grandparents again or parents, them able to transfer funds into the child's name for the use down the road. Contributions with after-tax dollars, again, those are going to be contributions from parents or grandparents generally, but it's going to be after-tax contributions. What is the difference, right? A UGMA contains only financial products generally financial products such as stocks, bonds, and mutual funds, where a UTMA may have other financial assets or physical assets, for example, real estate, jewelry, and fine art. Taking a look at the pros and cons, right? The pros, flexibility of use. This doesn't have to be used solely for college funding. There's a flexibility in investments, right? As we were talking about the difference between the two plans. And generally, there are no limitations on contributions. Generally, the contributions or transfer of assets is considered a gift to the child. And I am not a CPA or attorney, so I would highly recommend, if you want more specifics, to reach out to a tax consultant for additional details. But generally speaking, in either of these plans, that if there is gain or interest earned, that would be taxable to the child when that interest is earned. Now, the cons, there's a loss of control, right? You're transferring ownership of an asset and putting it in either of one of these plans. There is an impact on financial aid, of course. These are going to be assets that are in the child's name, and then there are earnings subject to tax consequences, again, assuming that either of these earn interest. Now, before we get into IULs, we'll cover the Coverdell Education Assistance Account, which is on the next slide, Beth. Right, it's going to be a trust account created by the U.S. government for educational expenses, generally established for a child well before the age of 18. Funds must be used by the age of 30 by the child. The main restriction here, and as you can see on the screen, is that in any given year, the beneficiary can only receive up to $2,000 in a Coverdell Education Assistance account. And then there's a limited audience if contributors' income is too high. So again, thinking back to the parents or single parents' annual income, they may lose or have limited access to a Coverdell Education Assistance account. All right, and generally what we see these set up for, similar, right? This is going to be similar to a 529 plan, although we're seeing Coverdell Education Assistance or savings accounts generally set up for elementary and secondary school tuition, although it could be used for college savings account as well. Taking a look at the pros and cons for a Coverdell Education Assistance account, right? Pros, tax advantage, tax-free withdrawals, assuming that there are qualified withdrawals, generally covering elementary and secondary tuition expenses, so thinking private schools, so forth. And then when it comes to the cons, right, the funds must be used by the child's age of 30. Generally, that shouldn't be an issue with most children, out of school and in the workforce by the age of 30. Again, considered an asset, so it can have an impact on financial aid, and it's ineligible for loan repayment, and there is that really restrictive contribution limit of $2,000 annually. Now, talking about the flexibility that offers here on the next slide, a fixed index universal life or an IUL savings plan, right? It combines the features and benefits of a traditional universal life product, but there's a difference in the crediting method. As we know, it's linked to an index, which offers a floor upside potential, but although because it's an indexed product, there's a cap generally on the upside potential. The earnings within an IUL are going to be tax deferred, and if properly structured, they're going to be able to take tax-free distributions out of the contract. And then there's a potential for higher than average crediting rates in compounding than traditional UL products. Again, an IUL is going to offer a significantly higher flexibility. There's going to be no contribution limits when it comes to an IUL. So whether a parent or grandparent has $50, $100, $200 a month, or maybe there's a grandparent that wants to contribute $1,000 a month, or it could be a parent, they're able to do so. And then, one key feature that I find very interesting related to F&G in regards to IULs. In 2022, we issued 85,000 contracts, right? We were number 3 in the IUL space for carriers with the most policies issued, and 25% of those policies were issued on juveniles. So this is definitely a market that is somewhat of a niche market for us. Our product performs really well, and we've seen a significant amount of advisors positioning an IUL with the clients that they're working with. Again, whether it's parents or grandparents, they're both eligible to put these plans in place for their children or grandchildren. Talking about the pros and cons when it comes to an IUL for savings. Again, the pros, right? Although I would consider what I'm about to say here to be a con, individuals are going to use their after-tax dollars to fund an IUL, but the pro is that that's going to be a tax deferred. And again, ideally, if it's structured properly, it's going to be a tax-free distribution, no contribution limits. The cash value is not considered an asset when applying for federal financial aid. There's downside market protection, right? Generally, IULs have a floor of 0 at a minimum, and there's a lot more flexibility in the design. As I mentioned, what if the child doesn't go to college, or what if they get a full ride scholarship? They're able to keep this plan in force. They're able to use it maybe down the road again to pay for the startup of a business. Maybe they want to use the funds as a down payment on a house, or maybe they just want to let the account value build up and let the compounding interest work in their favor, and they can use those funds sometime later on down the road. Cons, right? It's going to be best at younger ages, just like any other type of savings plan. The longer you have to let compounding interest work in your favor, the better off we're going to be. There is a surrender charge structure or a penalty if the clients would go to surrender the policy within the surrender charge period. And then there is some limitation to the growth options within an IUL, right? We do have that downside protection, but generally the downside protection means the trade-off of having a capped upside protection. Although I think with most carriers, specifically with F&G, there is significant upside protection when it comes to the index strategies available within our IULs. Now, moving on to the concept of $1 million baby, right? I think this is a really appealing concept or marketing ploy or conversation to use with your clients, right? With very minimal funds today, your clients are able to put a plan in place that can generate up to $1 million, roughly $1 million. Of course, it always depends on the client's age and the premium amount, but roughly $1 million at the age of retirement, again, with very limited contributions. So taking a look at the first example here, Beth, the F&G IUL example, Juvenile. This one's going to show 2 income streams, right? So let's just assume, right, we're working with a female age 1, so a juvenile. Here at F&G, we do have juvenile rates at standard juvenile rates, although they are considered non-tobacco. I do know some carriers consider juveniles to be tobacco rated, so that would be increasing the cost of insurance. In this example, we're assuming that, again, either the parents or grandparents are paying $200 a month into the policy. We're going to assume that premiums are paid for 20 years. And then we're going to take or illustrate a loan coming out, a one-time loan coming out at the age of 22. The concept behind this is show the parents paying the premium into the policy, let them, qualify for financial aid, take out any type of loans that they're eligible for, And then after the child graduates college, they're able to take out a loan to pay back any student loan debt that has been incurred. Of course, you can change the design to fit the specific client that you're working with. This is one that I like to highlight. Again, allowing those funds to sit in there a little bit longer allows for more compounding interest. The index strategy we used here is our S&P high cap strategy, which has a cap of 12%. So again, a very strong, if not one of the highest cap rates in the industry when it comes to an S&P strategy. And then we're going to use that, typical case design when it comes to IULs, and we're designing towards cash accumulation. So an increasing death benefit during the premium paying years, and then switching to option A or level when we show retirement income to maximize distributions out. And we do have a very simple or easy solve in our illustration software that's called, solve for max accum and income. So let's take a look at the results on the right-hand screen here, right? So starting out, we have $150,000 worth of coverage. So here we have a juvenile, an individual at the age of 1 who has $150,000 worth of life insurance coverage. Keep in mind that that's also going to help protect their insurability down the road. What if the child, develops some type of condition and they're uninsurable in their adult years? Well, thankfully, their parents put in a plan that gave them some type of insurance or some amount of insurance when they were insurable. And of course, later on down the road, that means they also have access to living benefits. The account value at the age of 65 is going to be $400,000. That already takes into consideration the one-time loan at the age of 2020 or the age of 22. Again, in this example, they would be able to take out a loan of $90,000 at the age of 22, again, to either help pay back any student loan debt that hasn't occurred, or possibly pay for future tuition costs if the child going to school for more than 4 years. And then, this plan just doesn't stop at the age of 2022. What if they just let it sit, cook, continue to gain interest? Well, in the illustration from the age of 66 to 90, that child would be able to borrow $45,000 annually to help supplement their retirement income. Now, we don't do our jobs for free. I absolutely know that. On a case design similar to this, depending on which product you're using, target premium is going to be $300 to $500. And now I know most of you on this call are likely writing a lot of cases with target premiums higher than what's illustrated here. Generally, what we see in the industry, and as all of you know, the younger individuals are going to have lower target premiums. But as we get into the product and the process that we've built around juveniles and submitting applications, we have a significantly enhanced, streamlined process that is going to make it super quick and easy for you as agents to submit business with us and reduce the turnaround time, meaning you're going to be able to work with either more juveniles or more clients, and there's going to be less, day-to-day follow-up on cases of this size. Now, this is second example here, Beth, I'm going to spend less time going through the case specifics. Very similar setup in regards to a female age 1, same premium amount. The only difference here is going to be that the clients are going to pay premiums to age 20. Of course, we're assuming that the ownership is going to be transferred to the child. And then once the child is in the workforce, they're going to pick up paying premiums again at $200 a month from the age of 27 to 65, right? We talk about this all day long with our individuals in the workforce now. What are you doing to help supplement your retirement income? Maybe you have an annuity, 401k. You can possibly think about Social Security. So of course, this is going to be a conversation that's going to be relevant when the child's in the working force. Again, starting out with a $150,000 death benefit. Now, the accumulated cash value illustrated at the age of 65 is nearing that $1 million. Since the child picked up paying additional premium, there's $830,000 at the age of 65 that they would have access to. The income here at the age of 2020 is going to be the same at $90,000, but again, they could use to pay back any student loan debt that has been occurred. And then here, because the child picked up paying premiums from the age of 27 to 65, they would have access to $85,000 a year from the age of 66 to 90. Similar target premium, and I always like to highlight an illustration the total assumption. So let's just take a look, or what we pointed out here, at the age 100 snapshot. So total premiums paid into the policy, and this is no small chunk of change, but remember, this is spread out over a 64-year period of time. It's $139,000. They paid in $139,000 over the life of the contract. But get this, the total projected income, if we add up all of the loans in the policy that they were able to borrow, is $2.2 million. Over $2.2 million that they were able to take out income tax free. And then at the age of 100, there is a residual death benefit of over $800,000. So again, very strong story here. Of course, I'm a little biased since I work for an insurance carrier, but I find this plan design, or using an index universal life product, to be significantly more appealing than using any of the other college savings strategies that we used before. So moving on to the next slide here, Beth, right? We're just gonna spin a little bit and just talk about the product features. I just wanna make sure everyone on this call is equipped or knows a little bit about the product. But what I will say first is, don't feel like you have to be the product expert. You have a great team at IMES that's able to help out if you have questions or need help positioning the path setter product to your clients. And of course, we have a team here at F&G that includes myself as the national account manager. And then we also have a sales desk that is available 8 in the morning to 5 o'clock at night, Monday through Thursday. And then they're available 8 to 2 Central Time that is also able to help out with illustrations or any product questions. So in general, when we're talking about why F&G for IULs, now this is going to be applicable not only for juveniles or those thinking about using an IUL for college planning, but also individuals that are adults. We have a really great product for adults as well. Right? Why IUL and writing that business with F&G? Well, we have a really strong product performance driven by reliable cap rate history. I mentioned in those two examples, we have our S&P strategy, has a cap of 12%. It has been on our path setter product chassis since 2012 when this product chassis was released. It started out with a cap rate of 13.5%. It's gone as high as 15.5%. And today we have a cap rate of 12%, which is the second highest cap rate in the industry compared to our peers. Now, we all know that clients are able to take tax-free distributions or loans from an IUL via the way of a loan, right? We know that's written into code set by Congress, that clients are able to take distributions or loans from their policy income tax-free, again, if they're set up and structured properly. Well, here at F&G, our variable loan rate is contractually guaranteed to never exceed 5%. That is one of the lowest, if not the lowest, variable or participating loan rates in the industry. And that means no matter the interest rates in the future, thinking about even right now, we're in a high interest rate environment. Loan rates are significantly more than 5%, but clients will never be charged more than 5% to borrow that money from their contract. Now, just as important as it is to have a reliable and strong cap rate history, it's also important for clients to have options in the index strategies that they have access to. And my favorite index strategy here at F&G is going to be our Barclays Trailblazer Sectors 5 Index. This is a volatility controlled strategy. And what I love most about the Barclays Index is that it's uncapped. There's no spread, there's no fee for this strategy, and it has a really high participation rate at 170%. And if all of that wasn't enough, there is a 1% bonus that's credited to the policy's account value in contract years 2 and on. So no matter the index performance on the Barclays Index, clients are going to receive at least a 1% bonus in years 2 and on. And again, if the index, returns 15%, we're going to tack on that 1% bonus to the 15% that they earned. Again, all of that really ties into why the Barclays Index is my favorite index strategy. All of our path setter policies that are issued automatically come with living benefits for critical illness, terminal illness, and chronic illness, as long as the client is a Table 4 underwriting class or better. And then we have our exam-free underwriting program, which I'll get into more details here in a few moments. Now on the next slide, Beth, I'm not going to be spending too much time covering the specifics on the product, but there are a few points that I do want to highlight. Right, it's available for clients. I alluded to that the Path Setter product is great for most quartiles across different ages and face amounts, but it's available for clients between the ages of 0 and 80. So as long as that child has a social security number, we're able to accept coverage or accept an application on that child, and they have to be at least 15 days or older. And it has a product minimum of $50,000, right? So those examples we took a look at were for $200 a month. Of course, parents or grandparents could pay significantly more than $200 a month, but we also know that that's not going to be a budget for every client you're working with. So if those individuals have, let's say, a budget of $50 a child, we can bring that death benefit down, and it's also going to offer a very appealing case design. Distribution options and account value enhancements, you can see those on the screen. I'd be happy to go into more detail at a later time, or you're welcome to reach out to our sales desk to get more specifics there. But I do want to point out that the floor or guaranteed interest rate on our Path Setter product is higher than 0. So at a bare minimum, again, no matter the index strategy selected, age, or face amount, clients are at least going to receive a 25 basis point floor. So every year, no matter the index performance, they're at least going to receive some interest inside their policy. And of course, if we're talking about the index strategy that has that 1% bonus, that's going to inflate that floor as well. Now I'm going to go ahead and skip over the living benefit riders, Beth. I think it's more important here that we spend the last minute talking about underwriting. We do have exam-free underwriting. It's going to be available for clients between the ages of 0 and 60 up to and including $1 million worth of coverage. Exam-free underwriting is unlike accelerated underwriting in the way of we do not require a paramed exam, blood, or urine for those that fit between those parameters of 0 to 60 up to and including $1 million worth of coverage. 90% of our exam-free applicants are approved at standard or better. And again, I told you that we have a program in place to help you more efficiently and effectively work with more clients. And that is because exam-free underwriting, the average turnaround time is 5 calendar days or less. So we receive an application one day, and within 5 calendar days, 50% of our exam-free applicants have an underwriting offer, and the case is already being sent to issue. Now, the last slide here that I'll go into detail on is the Wizard and Insta Approval. About 4 months ago, we launched a new e-app platform. It is through Firelight. We are calling it the Wizard e-app. It's a more user-friendly e-app experience than what we had before at F&G. And the Wizard e-app allows us to offer real-time underwriting decisions at the time of application, which is what we call Insta Approval. So Insta Approval allows for point of sale decisioning, meaning an underwriting offer at the time of application. And as this sits today, Wizard eApp is available for all clients that you're working with. Insta Approval is going to be available for applicants between the ages of 0 and 17 through $200,000 worth of coverage. So that means you could sit down with, again, parents or grandparents today, take an application in as little as 30 minutes and have an underwriting decision on the screen, and you're able to let the client know that the next time you see them or the next time you hear from them, it's going to be to deliver the policy. I talked about how we have a streamlined process, Insta Approval, the Wizard-based e-app. All of that is going to allow you to work with more clients and work with clients more efficiently and effectively. And I will give you a little bit of a teaser here. we are planning in 2024 to increase the Insta approval eligibility. Our goal ultimately in 2024 is to bring the maximum face amount up to $1 million and up to the age of 60. So we're able to, have that point of sale decisioning for more and more applicants. And with that, Beth, you're welcome to leave the contact slide up. That's my contact information there for the support that you have at IMES, or who supports IMES from an F&G standpoint on the life side, the internal wholesaler that I'm working with, Sandy Beheimer. And then again, if you have any real specific product questions or need illustrations, I highly recommend that you reach out to our internal sales desk. Their phone number and email address is listed on the screen as well. But with that, I just want to thank everyone on the call and the IMES team for allowing me to participate today.
Thank you, Miles. This was awesome. A lot of great content there. I'm a big fan of juvenile policies. I've been in the business 21 years, and I have definitely delivered death claims on juveniles, which we don't want to talk about. But I also have seen situations where insurability has been protected because juvenile diabetes was diagnosed, childhood cancers, things like that, make it harder when they're of adult years to buy life insurance. And then it is a huge, wonderful gift going forward. I know for my kids that I feel like kids are my kids are 19, 17, and 14. I expect them to be kind of morons until they get to be 25. So, it's a good way to set up a savings account that they can take over when they get out of college and get their first job, and teach them how to have another tax-deferred savings besides the college funding part of it as well. So I am going to ask you a couple poll questions if you guys don't mind answering these. The first is, would you like a copy of our year-end planning kits? All right, I'll close that one. Okay, and then lastly, if you're interested in software that can help you present the benefits of IUL versus other tax-deferred options. While we're collecting that, again, Miles, thank you so much. It was really great. I'm sorry for the technical difficulty, but I think we got it worked out. Everyone have a happy holiday, and please reach out to any of the life sales directors or our life team. If you have any questions on this, we'll be reaching out to you as well. Have a great day.